there that will allow us to pay off the mortgage, obviously, before its duration. And the third thing then, I've kind of used the phrase insurance cost reduction. It's not just insurance costs. It's about how can we save money that will give us more money to pay back the bank. It's a very simple thing to say, and it's actually a simple thing to do, but we need to be very diligent in the way that we go about this. Okay. So starting on the first topic of mortgages, mortgage rates have come down in recent years. I think most of us would accept that. And the average mortgage rate in Ireland is currently 2.79%. The average mortgage in Europe is about 1.35. So we're still paying roughly twice the average European rate for mortgages. Now, some of you on this call may be on a tracker, which if so, is obviously the most attractive form of mortgage. And generally speaking, it is not sensible for people to pay off a tracker. For those of you that are on a fixed rate, however, or a variable rate of mortgage, I do feel that there are opportunities, particularly at present, for you to consider the rate that you're paying versus what is available to you. And this may include paying a penalty to get off a fixed rate. I've done this for a few clients over the last couple of months, and they've made a considerable benefit to themselves by actually coming out of a fixed rate. But again, it's more about information, and I'm a key believer of, information is power. So what I'm saying to you all is that by taking the time today, you obviously have an appetite and interest in this. If you are on a fixed rate mortgage, if you're on a variable rate, or indeed if you're looking to get a mortgage in the coming year or two, you need to think about the interest rate that you pay the bank. I talk to a lot of clients, and the one question I always ask them is, what is the rate of interest that you pay the bank? And respectfully, it's not really acceptable to say, I don't know. It's like having a financial product and not having any sense of what you paid for it. It's like saying you don't know how much you paid for your car. So again, the key thing to understand is that if it's not 2.5% or slightly higher with cashback, you should consider, why are you paying a high rate? I come across clients who are paying 3%, 3.5% interest rates. And I'm baffled by the fact that, with very simple steps, they can get that interest rate down. The main one is to go back to your own bank. It's not about putting people through hassle and rigmarole. So the one thing I'd like to say to you all is that if you're paying, a bank 3%, go back to the bank, but go armed with some information that we'll happily provide you. And the thing I should have said to you at the start of this is that Alpha Wealth do not sell mortgages. So we have no bias in this. We operate as independent financial advisors. There are some financial products that we do sell, but the mortgage side of things, I don't spend my day dealing with. So I feel it's better to speak to experts. So the two things I'd say are, firstly, arm yourself with information about what is the rate of mortgage that you can achieve. I'm sure some of you are aware that Advent announced there a few months ago that they are offering mortgages at approximately 1.95%, which is a significant reduction on the main banks. And it's important to understand whether or not you apply, you can qualify for this mortgage or not. Their main criteria is that you have to live near a city centre, so they won't lend to people who live out in the suburbs, and that you have to be in a job for 2 years or more. Okay, so some people may not qualify under those criteria, but if you have good equity in your home, and if you have worked in a company for more than 2 years, and if you are living somewhere near a city centre like Cork, Galway, Limerick, Dublin, you should honestly look at whether or not there's an opportunity for you to move and take advantage of a massive interest rate reduction on what you're paying. Okay. I mentioned about Alpha Wealth and where we come into this. Again, we're happy to talk to individuals who have a mortgage, who are looking to apply for a mortgage. We help people get mortgage ready. And the key thing to remind you of is that we have no bias in this area. There is one financial product that we do sell, which is mortgage protection. And the only thing I say to people is, I worked in the banks for many years. I was with AIB for 8 years all told, and an Ulster Bank for several years. I was the guy sitting in the room next to the mortgage advisor. And as soon as someone signed up for the mortgage, they were wheeled into me and I'd sell them the mortgage protection. It was a gimme. It was like shooting fish in a barrel. And the problem was that we were tied, so we weren't going to shop around for the individual, and we weren't bothered about giving them the best rate. So for those people that are currently paying mortgage protection, it is an area that I would say for you, you should consider the cost of what you're paying versus what is available to you. And it's an easy area because you can compare apples with apples very simply. You know, we ask a couple of questions. What is your date of birth? Have you smoked in the last 12 months? What is the amount of mortgage that you owe? And what's the term remaining? 4 questions. And by virtue of getting the answer to those 4, we can tell you very quickly whether or not you're overpaying for a protection policy that you're most likely never going to avail of. It is a legal requirement to have. But are you paying more money than you should be? Because that's a waste of money. Okay. I'm just going to briefly mention some of the rates that are out there. A lot of people have dealings with, say, Bank of Ireland. They were relatively attractive for fixed rates. They are no longer attractive, in my opinion. There are other banks. I mentioned Advent. I've put on their fixed rate currently, but you can get lower if you have good equity in your home, typically 60% loan to value. PTSB have announced several rates now. They have some slightly higher rates with cashback. And it's more about just being aware of what is available and the opportunity there. Again, AIB have announced lower rates. There is this kind of green mortgage now, which people can apply for if they have a good BER rating. But the key thing to note is what can you qualify for and what position are you currently in? Okay, and it is important for people just to get some advice. And more importantly is don't pay for it. You know, you don't have to pay for the advice, and you wanted to make sure that it's independent and is straightforward. And David, myself, David previously worked for Bank of Ireland. He'd be a fairly expert in, you know, discussing mortgages with individuals, which was a role that he had previously. So I'm just going to move on. One of the things about being able to pay off a mortgage is about amassing monies. Okay, so what I mean by that is that I come across a lot of clients that have an opportunity to save, and I come across a lot of clients that have an opportunity to invest. And the key thing to note is that if you can build up money, either via your pension or your savings or your investments, it allows you an opportunity to pay back the bank early. And this is the key theme of what I wanted to come across today to you. So what I'm saying to you is that many of you on the call might have 15, 20 years left in your mortgage. I can't get you to clear off that mortgage today, but what I can say to you is that if you apply some of the steps that I'm going to go through with you, you should have the opportunity to pay it off 5 or 10 years early. And I mean that. And that's without doing anything overly dramatic. You know, I can't increase your income, but I can increase the amount that you have after you pay your tax on your earnings and put it to better use. So I've mentioned here about getting your money working harder for you. It's a really easy concept for us at the moment because obviously the banks, credit union, post office are paying 0%. So I'm going to give you a couple of examples today about how you can get your money working harder. And we've all been affected obviously by COVID in the last 12 months, some of us more than others. I am coming across more and more clients, as David is, that haven't been able to spend the money that they were used to. You know, we haven't been able to go on our foreign holidays or pay money for restaurants and so on and so forth. And it's about putting that money to better use. And there are a few opportunities available to people, particularly for those of you that are high rate taxpayers, that will enable you to build up this nest egg, this war chest, and pay the banks back early. Okay. So the first thing to mention is, and again, as a takeaway today, the chart that I've thrown up on the slide there, everyone has a number. And what I mean by that is that, you know, when you talk about investing and you talk about, you know, the return.
Sorry, Nick, David here. There's no slides on the screen. I'm not sure if they're supposed to be.
Oh, sorry, David. Okay. Thank you, David. Can you see that slide there? David, is that appearing?
No, not for me. I don't know. Is it for anyone else?
Yeah, that's that. Short slide on again. It was appearing there. Now it's sharing. It's perfect, Nick.
Great.
I can see it as well, Nick.
Great, thanks. So just to mention, guys, that this table here that some of you might be familiar with is the risk reward table. And it applies to different things in terms of, you know, any monies that people have. So those people that, for example, have pension schemes and have 10 years plus to retirement, they should be up around the 5, 6 level on that table, because they have time left in that would allow them to take some risk. For those people that obviously have only 1 or 2 years left, they will be lower down on that scale, and so on and so forth. The key thing for a lot of people out there are that those people that have money sitting in the bank, credit union, that would be deemed under risk profile 1, where you make nothing, you lose nothing. And all I'm saying to you is that your opportunity at the moment is to get that money and put it to better use, or to take some of the monthly earnings that you have and put it into schemes that will give you a considerable return on your investment, that would allow you to pay back the banks and beat the mortgage interest rate that you're paying. Now, I'm not going to dwell too much on this, and this is really where myself and David would delve a bit deeper. But for anyone that's sitting in cash positions in the bank, honestly, outside of the emergency monies that you need, I honestly believe it's a waste of time leaving money there. And I'm not being disingenuous to the credit union, to the post office or so on. I just don't like them because they don't pay interest to my clients. So as a financial advisor, my objective is to say, okay, well, can I find another opportunity? And opportunities there are out there for certain, okay? So again, just to kind of show you one of them, and a very, I suppose, relevant one to a lot of people on the call, is that if you can build up 5,000 euros as a minimum in 2021, so you don't have to do it today, and David and myself will help you build this money over the coming months, where you can invest it for a 4-year period. The Irish government will give you back 40% of your investment next year. And at the end of the 4 years, you would look to get back your investment, which in this example was 5,000 euros, and receive, roughly speaking, 20% net of tax and fees from that. Now you can do the math on that, and I'm going to show you the worked example. So to repeat, you put in 10,000, the Irish government give you back 4,000 next year, and at the end of the 4 years, you get back your 10,000 plus approximately 2,000 euros, 20% back from the company that you place that money with. That's a double your return of your investment. So if you were thinking, well, okay, Nick, are you telling us we should pay off our mortgage early so we can pay the money from the credit union into the bank? That's not what I'm saying. What I'm saying to you is that consider opportunities like putting the money into an EAAS scheme. It stands for the Employment Investment Incentive Scheme. It's a government scheme where not will you benefit from reducing the cost of your mortgage interest by 3% a year on average, where you can actually get a 10% per annum savings from the government, which is by virtue of a tax rebate, but also a further 5% return from the company. So that's 15% per annum that you'd look to make on your investment. Now, the one question a lot of you may have, and I'm often asked, as David is this guaranteed? No, it's absolutely not guaranteed. And if I said it was guaranteed, you should come off the call and get on with your lives. Anyone that suggests that you can get these sorts of returns is saying that there's risk involved. What is the risk with this scheme? Well, the risk is that the company that you lend the money to defaults on paying you back in 4 years. Now, the skill for David and myself is to identify, of the 70 or so companies in the Irish marketplace, which of those are less likely to default. And there are some very strong companies in this space. I mentioned at the start of this call a webinar that I'm doing next month on the 23rd of April, which will showcase one of the companies in this. And myself and David are not biased to those companies. So again, as an independent brokerage, our job is to narrow down the companies in this marketplace. One of the companies that is mentioned on this webinar on the slide here is MX. They're an IT company. Their turnover last year was 2 million euros, and they grew during the pandemic. They provide these kind of SaaS software solutions for people working remotely, and there's some really good clients in the Irish marketplace. And David and myself know the MD, so this is not a black box of people that we wouldn't be familiar with. Red Earl is a whiskey company called Kinsale Spirit. Some of you may know the owners of the company, a guy called Ernest Cantillon, who owns the Electric and Sober Lane. Another guy called Colin Ross, who used to own Clancy's, a really good, well-managed company. And you get to see their perspectives. You get to identify the company. You get to see what the opportunity is, and you go in with your eyes wide open. So just to highlight, and again, I'm not going to dwell too much on this. If you are in a position where you could say siphon 5,000 a year, and this is where David and myself come in and help you make the savings to generate that sort of return. And let's say you did that in 2021, 22, 23, 24. So you did it annually for the next 4 years. And there's no requirement for you to do that, by the way. This can be done on a once-off basis. But you'll be getting the tax relief back every year from next year after. And then you're looking to get your return of 20%, obviously at the end of 4 years. And you can see from the slide here, it starts to become a self-financing scheme, because what's happening is that every year you're getting this tax rebate, and at the end of the 4 years, you're getting your money back plus the 20%. And essentially for your total investment, where you're getting, the 2005 plus the 20% back, the significant return on your savings. So you can invest a figure of say 20,000, get 8,000 euros back from revenue, and get back 32,000. It's a massive return on investment. And then you take that 32,000 and you pay the bank back that balance. And I'm going to show you the effect it'll have on your mortgage if you follow this principle, even just for 4 years, even for a moderate amount of 5,000 euros. Now, for those of you that are on higher incomes of say 60, 70, 80,000 a year more, your opportunity to do this scheme is higher. It's about the amount of income that you pay at the top rate. The other opportunity is pensions. A lot of people have an understanding of pension schemes to some regard, but I don't know if people really understand it. Many of the people on this call may have a company pension plan through their employer. Are you taking advantage of the AVCs, the additional contributions that you can make? Are you aware of the limits that you're allowed? Have you utilized them in the last 12 months in lieu of the money that you were spending on other things? Because if you hadn't, you probably should consider that. Why? Because not only will it give you an opportunity to retire earlier, but it'll also give you an opportunity to pay back your mortgage earlier, because your ability to use your pension fund comes from the age of 50 onwards. And I suppose the one thing I'm trying to point out to you today is, and it's not a trick, it's not a magic wand solution. If you build up your pension fund significantly, the longest term that you'll ever have your mortgage until is age 60. Because what you'll do at that stage is you'll consider looking at drawing down your 25% tax-free sum and paying off whatever the remainder of your mortgage is. And if you take that philosophy further, you might bring it back to 55 and pay it off at that stage. And you may be in a position where you have more than one pension scheme. So you may be able to draw down different pensions at different times. And this is where a bit of financial planning comes in play. One of the key things I want to say to you today is that you should have this roadmap. Somebody joked with me the other day, said, Nick, are you like Owen McGee? Now, Owen might hear this webinar at some point, and I think I'm allowed to say this because I used to work with Owen many moons ago in Ulster Bank. I'm delighted that Owen McGee has got himself on television, because he's made people more financially aware. And we provide the same level of service in terms of different areas of financial planning. Okay. So just to move on from this, there are other things that you can do to reduce the tax you pay. The main two really for any people that are PAYE working for companies is pensions and the EAS scheme that I mentioned. For those of you that are self-employed or like myself, set up a company, there are more opportunities available. And I would really encourage you to get appropriate advice from David or myself. But there are some other things that you can do. Like, have you taken advantage of the stay-at-home relief? A lot of you were forced to work at home last year. Did you claim the 10% of your expenses that revenue will allow you? Or did you go to your employer and find out whether they pay you the €3.20 per day, which some companies will provide for you? That's money that if you haven't, you've just thrown away, because it's perfectly legitimate for you to do so. And it's not difficult. And myself and David help people go through the claim on the ROS system, which is the revenue online system. And again, don't let ignorance be an excuse. Not a difficult thing for people to do. So just to briefly finish off on the last area that I wanted to talk about, protection and insurance. I can tell you the number of people that say to me, Nick, I shop around for my insurance, I'm okay. And I say to them, do you know what? I don't sell car insurance, I don't sell house insurance, and I don't sell health insurance. But you know what? Do yourself a favor and just send me on your renewal notice when you next get one in the post or by email. And I guarantee you that will save you money. And you might say, Nick, well, how can you say that? You know, sure. What gives you right to say that? Well, I have never met a client that we've ever come across that has paid the lowest amount on those financial products. Health insurance, okay, there is a plethora of plans out there. There's 480 plans currently at the marketplace in Ireland. Some of you may have health insurance through your employer and say, oh yeah, Nick, I'm well covered with that. I was talking to a client yesterday that said, oh, I'm allowed up to $2,500 a year on my health insurance, so I have a really good plan. There's nothing you can do to help me. And I said to him, well, okay, but by the way, you're paying 40% of that cost because there's a benefit in kind. Are you really sure that you want to spend that amount of money on that level of cover? Because it's going to cost you €1,000. I have a plan with Leia myself personally. I'm 47 and I think I have a really good plan. It's called the Flex 500 Explore. Not biased by it. It doesn't have any outpatient benefits, which I don't particularly care for, which are things like GP visits and physio, but it has really good inpatient care. And it costs me about €900 a year. If you were to buy it on the phone to Leia, they'd charge you 1,000. You buy it online, you save yourself 10%. I have 3 children. I've never paid full health insurance costs for them. I've availed of kids' offers. And these are small things that people should look out for. And the health insurance companies, unfortunately, are not of the, I suppose, mentality to explain things to you like that. And it's about getting this independent advice. But you'd be amazed by how much money you can actually save in this area that would allow you to go back to what I was saying at the start about putting your money to better use, enabling you to pay off the mortgage early. Now, just to kind of finalize that, again, many of you may have mortgage protection insurance, many of you may have life cover, many of you may have serious illness cover. It's worthwhile just considering what it is you're insured for and is it still fit for purpose. I come across a lot of people that they made financial arrangements and there's nothing wrong in that, but it doesn't suit their requirements now. You know, their dependents may have grown up. They may have joined a company that has work benefits that they never had previously. And obviously it makes sense for them. And the problem with people in the financial services sector is they're mad to sell you products to make commissions from you. What I can say definitively about Alpha Wealth is that we're very transparent. We're a low cost company. And you know what? I'm 47. I own the business. I'm in this for the long haul. Myself and David want to make sure that we look after our clients. It's the mentality that we take. So if it's not right for the client, then so be it. I told a client earlier to pay off their mortgage. And they were saying that people told them that they shouldn't because mortgage rates are low. But I said to them, but you're a very conservative individual. I can't get the returns that your mortgage will save you on by you paying it off early. They were paying approximately 3% of their mortgage. Once you allowed for tax, I'd have to get the equivalent of about 5% per year. I said to them, that was the best investment you'll ever do by paying off your mortgage early. And they're going to do that. They received a redundancy payment that has allowed them to do so. So again, it's not like one fits all solution. It's about anyone's individual circumstances. Now, I just want to finish off by just giving you a very specific kind of worked example. Joe and Mary Bloggs, 40 years old with 250,000 on their mortgage, 25 years remaining. So to put some action steps in here, the cost of their mortgage at 3% is roughly about 1,200 quid a month. It'll cost them roughly about 360,000 over the term of their mortgage. By them just taking advantage of a lower rate of 2.5%, which, as I said to you, is very easy in this environment. They can reduce their monthly repayment to 1,100 a month, or they can use the overpayment to reduce the mortgage term down by 2.5 years approximately and save themselves about 20 grand. So that's an easy one. So I've achieved my objective in the webinar, which is to reduce the term of your mortgage by just one really simple thing that won't cost you a penny, and it's probably just a phone call away. However, I think you can go further, because if you can then reduce the mortgage interest rate further, obviously you shave more off your money. If you can get that money working more for you, build up this fund through the likes of AVCs and the EAAS scheme that I mentioned, you can bring that mortgage term down further and further and further. And then you add in the insurance cost savings, which will be significant. And I'm amazed by the amount of money that people spend on things that they don't necessarily need, or indeed they have, but they're paying too much for. And if you take that mentality, which is quite straightforward, by the way, and just carry it through over a process of years, you'll be amazed by the amount of money that you can save. Okay. And I just want to finish this by saying to you that, you know, I'm 47 and I'm in a position where I am mortgage free, and I haven't done anything scientific. I'm just saying to you that if you can follow certain steps, you'll be surprised by what you can achieve. Okay, so I'm bang on 25 minutes. I've said kind of what I wanted to say. I just want to mention again, lastly, that David is doing a webinar next Friday on income protection. If you'd like to listen into it, or indeed if you can't make the webinar, we record the webinars and we're happy to share them with you. I will provide the slides and the video to those of you afterwards. And again, if anyone would like a little bit more information on any of the areas that I've covered, or indeed just want a general chat, or if there's one particular area of interest that I've touched upon that you'd like to discuss, you know, things like children's savings, you know, anyone that has kids, I do encourage them to look at alternatives to the banks, because it doesn't sit well with me, you know, people putting money away for a long period, earning 0%. Or indeed, if it's just a legacy policy you might have, it might be an old pension scheme where you're not really familiar with, you know, where it's at, and just to get some advice. We don't charge for the advice, and as I said to you, we operate as an independent brokerage. So I'd just like to finish off by saying I hope you enjoy the weekend. Thank you very much again for your time today, and we look forward to kind of speaking to you, though. And for those of you that have dealt with us previously, thank you again for the continued engagement. Thanks very much, guys. If anyone does want to ask me a question, please feel free to unmute your mic and ask away. I'm happy to stay on the call for a bit longer. Thank you.